Hey everyone, welcome back. Today we want to take a look at Volta. It's Wednesday, the markets are open. We want to talk about a few things, specifically the share price for one. By the way, this video is not financial advice, it's strictly for educational purposes. But there's some stuff that we need to talk about. For one, Volta Inc. receives notice from New York Stock Exchange regarding trading share price listing rules. So we got to check that out. Volta collaboration with awarded ARPAE funding to commercialize next generation fast charger technology. And of course, Volta Inc. reports third quarter financial results. We want to have a look at that as well to figure out what's going on with their charging station, how many they've got installed. Because it doesn't really make a lot of sense that this company is this cheap. I'm not complaining, to be honest, because I like cheap shares, especially when it's such a good company with such a good business model. However, what do we think about the management? Is the management good enough to lead Volta into a prosperous future? Because without the right management, your company is doomed. Without the right cash management, money management is essential. A lot of startups, they go under because they don't have the correct money management attitude, or the entire management system is lacking in some ways. So yes, let's get it out of the way. Share prices are absolutely cheap. And I'm loving it. I'm loving the cheap share price. And right now it's valued at 56.9 million in market cap. Let's remind ourselves at the outstanding shares, 173 million in outstanding shares. Now, even at that account, that's a low amount of shares. It's not even $250 million. It's not even 250 million shares. It's not even 500 million or 700 or 1 billion shares. This is less than $250 million shares. It is technically a low share supply. It's not an extremely low share supply, but it is still low. And why am I saying this? Because that is good. The less shares they are, the faster the share price can go up. The more you can gain in a shorter period of time. That's why companies like Apple, they have like 10 billion in shares. Because their market cap is so enormously large. If they had less shares, their share price would be too expensive for the regular average buyer. Apple likes to keep their share price just around $100. So as soon as their share price is getting to about $200, they basically split the shares, issue more shares, which brings the share price down. But this benefits the investors. This benefits people like myself, because if Apple doubles their share price and I own 100 shares, it turns out I now own 200 shares. Now, it's going to be valued at the same amount, but I now own twice as much share without having to do anything. So when they split the share, it's typically good for the investors and for the board members. But I just wanted to give you an example of why some company have a high amount of shares, because they want to keep their share price looking cheap. Amazon has split their shares recently. So is Google, because they wanted to bring the price down without bringing the value of the company down. And it typically works pretty well. Tesla did the same thing. Tesla did a 10-to-1 split recently. Very smart idea. So let's look at the information we can gather from Yahoo/BusinessWire. This is about the notice that Volta received from New York Stock Exchange. How serious is it? Volta Charging, an industry-leader electric vehicle charging and media company. By the way, they offer free charging through advertisement through their charging station. Very smart business idea. Now, they announced that they received a notice from New York Stock Exchange that the company's Class A common stock is not in compliance with New York Stock Exchange continued listing standard because the average closing price was less than $1, less than $1. So over a consecutive 30 days trading period, the notice does not result in immediate delisting of the company's Class A common stock from New York Stock Exchange. So I actually didn't know that this was a rule of the New York Stock Exchange, but it's very interesting. So if Volta wants to stay on at the New York Stock Exchange without getting delisted, will they have to reduce their share supply? Because if they reduce their share supply, the cost per share will increase. Understand, as an investor, you will lose shares. You will keep the same amount of value, but you will lose shares. But that's the best solution I can see. The problem is they already have an incredible low supply of shares at 56 million or something. That's already incredibly low. They already have a low supply of shares at 173 million. That's already pretty low, but it's not insanely low. They could always reduce it to maybe 50 million, 40 million, 30 million shares. I'd say probably, hopefully not less than 50 million shares, but hopefully they won't have to do this. But hey, let's see what the article has to say. The company plans to notify New York Stock Exchange by December the 8th. By the way, that's gone by now. That's 20 days ago because today's the 28th. So they intend to notify New York Stock Exchange that they intend to cure the stock price deficiency and regain compliance with the New York Stock Exchange continued listing requirements. So they want to stay on the New York Stock Exchange. The company can remain compliant at any time within the next 6 months following receipt of the New York Stock Exchange notice on the last trading day of any calendar month. During the cure period, the company has a closing price of at least $1. Yes, so they need to get their share price up. Now, the good thing is that if they reduce the share supply, this is actually good for us because this just means that whenever their share price go back up, it will do even better. To make a good margin on your return, it's typically best when the share price is less. It's typically less when there's less shares in the supply. The more supplies, the harder is it for the shares to go up. Less supplies, the easier it is for the shares to go up. So the company intends to consider available alternatives, including but not limited to a reverse stock split. That's what I mean. That's a reverse stock split. It's basically reducing the share supply that you have, which will affect every investor portfolio. It probably won't affect the value of your shares, but it will affect the amount of shares you have. Now, subject to stockholders' approval, so they have to get the board approval no later than at the company's next annual meeting of stockholders, if necessary to cure the stock price non-compliance. Under the New York Stock Exchange rule, the company determines that it will cure the stock price deficiency by taking an action that will require stockholders' approval at its next annual meeting of stockholders. The price condition will be deemed cured if the price promptly exceeds $1 per share, and the price remains above that level, for at least the following 30 days. Wow. So they probably have to reduce the stock price and make sure that the share price stays above $1 for at least 30 days. That's interesting. The company's Class A common stocks will continue to be listed and traded on the New York Stock Exchange during this period, subject to the company's compliance with other continued listing standards. Yeah, this is very interesting. I won't lie. But I think it could be a good thing for us as investors because, like I said, this share is already undervalued. If there's one thing to make me love this company even more is reducing the share supply. It's already a low supply of shares. If they reduce the share supply to, I don't know, 50, 40, 25 million, I don't know how much it will be reduced to. They're going to have to reduce it by a lot. Even if they reduce the share supply by 3, it still wouldn't cross $1. So they will have to divide the share supply by at least 4 or 5. Yeah, which will make the share supply less than 40 million. It will be around 30, maybe 25 million in share supply. They also want to make sure that it doesn't continue to lose supply in the following month. This is going to be very interesting. Now, additionally, just before we close out this video, I just wanted to add some good news. Volta is still developing as a company. The network of installed charge installs were over 3,093 as of September 30th this year, 2022. They added 173 charge installs. That's up 6% quarter over quarter and 45% year over year growth in installed chargers. They've almost raised the amount of charging stations they're installing by over 50%. Almost 45% is still pretty good. By the way, the Volta network surpasses 5,700 screens and 1 billion monthly media impressions. New advertisers include Google, Neiman Marcus, Fiji Water, Peacock, and Capital One. Repeat advertisements include Jeep, Target, Disney, Bank of America, Coca-Cola. So they are constantly increasing who they advertise with, who they partner with. The third quarter revenue increased by 69% year over year to $14.4 million. That's only the quarter revenue. That's not profit, by the way. That's just revenue. Sorry, that's almost 70% increase year over year in revenue. I'd like to talk a bit more about this, but this video is getting a bit long. So if you'd like me to make more videos on Volta, just leave a comment, leave a like, and also subscribe, and I will see you in the next one. Peace.